Let's start with Baltimore, Denise. Let me put it this way. You've modeled the prior shocks of the pandemic, the impact that had on supply chain. Do you consider Baltimore a data point that may show up down the line in these markets, or are you kind of sanguine about the lasting effect here?
I would say more in the sanguine camp. When you see supply shocks that affect the overall economy, they need to be a hit of about 1.5% to 2.5% of consumers' income historically to tip us into a recessionary impact. We're far from those measures probably on this. It doesn't mean that there won't be some interim issues, but I think that there are other cross currents that are less inflationary than potentially what we're seeing from Baltimore as well.
I'm just considering, materially what's happening there on the ground. I know Amazon has warehouses, but the scale seems small. Look, it is March 27th. Unbelievably, we're almost at the end of the first quarter, 2 consecutive quarters of gains. If you use the NASDAQ 100 as our kind of technology-focused proxy, what's your assessment of where we are in the technology sector right now as we approach the beginning of April, unbelievably?
Yeah, statistically, it almost looks like it's early innings to me. I think that there was a lot of concern from investors that technology stocks have moved too far too fast. And what you're seeing when the earnings came through, they more than delivered on the earnings that were expected. And the hockey stick we've seen in terms of the second derivative of earnings improvement is really something we haven't seen since coming out of the pandemic. And then before that, coming out of the financial crisis. So despite the fact that we didn't have a recession, this looks like a recessionary earnings recovery, historically speaking. And when you go back and you look at those, they tend to be very durable and lasting. So when you backtest all of what we've seen, and it's not just from the Mag 7, but when you look at that, it usually is the beginning of something that is durable into year 2 and year 3. And I think that's what investors need to start considering, not only for technology, but for the broader market.
So it's a question of weighing up data against your own sentiment, right? And when I was reflecting on earnings season, so much of the story was around artificial intelligence. And you see so many of the infrastructure names, not just NVIDIA, I'm talking about the server design companies, others in the stack, basically giving us a strong outlook for this year. But actually, at EPS level, outlook level, the numbers seemed good as well. Which was the more important factor?
No, I think that the more important factor was that it was across the board and diffuse, and that it was through all of technology. I mean, we have data going back for most of technology to the 90s and even some to the 60s. But when you look at the breakpoints in terms of operating margin expansion, which I really think is the driver behind the earnings recovery for technology as a sector, you'll see from the 10th percent breakpoint to the 90th percent breakpoint at the median level, all operating margins are now actually improving. And that's really the diffuse driver for the entire sector. And this is improvement off a pretty high level. There is nothing like that we saw in 99 or 2000. We're generating a lot more free cash flow in the sector off a higher operating margin base. We did see a contraction in operating margins, and now we're seeing that beginning stages of recovery.
And yet, despite us talking about FOMO in January, I'm talking about the fund manager surveys, net positions, I'm seeing a lot of outflows from technology funds. Why are you not worried about that?
Yeah, so when you look at it, there was, I think, the biggest outflow ever in the last month that we've seen historically. And that's true on a nominal basis, right? But when you rescale it for percent of assets or just even you rescale it for inflation, it starts to look fairly innocuous relative to sort of the headlines that investors were reading. And even though it is a bottom quartile level, so meaning that there was a significant level of outflows we haven't seen in quite some time, when you try and correlate that to anything in terms of relative performance, either past relative performance or even future relative performance, you can't see a very consistent correlation. If anything, over the last 10 years, it's actually been a bigger buy signal than a sell signal. So as much as, yes, it's concerning and headlines are concerning, I do think data can always help to say, okay, well, what are the relationships here? And do I feel secure in terms of betting on this as a top predictor? And I would say, based on my data, I would say be careful with that bet.
So one of the reasons I love having you on the program, Denise, is that you make your assessment and you review your model in the context of historical data. And you talk about data going back to the 90s. I know it's a single name, but Nvidia wasn't doing this in the 90s. There was not a euphoria around GPU and the ripple effect that goes to the rest of the server design, memory chips, the energy component of what's going on. Just explain to our audience how you model what I believe is kind of a phenomenon, right? Something that is new.
Right. No, it's always different, right? There are absolute differences cycle to cycle, and you picked a big one. But sometimes you can look at the differences and actually find out if those differences or the anomaly is predictive in and of itself. And you said we've never seen this before. Well, we did see bubble-like conditions in the late 90s, right? I mean, we saw it with different stocks, different names. But there was a disconnect in terms of valuation relative to earnings growth or free cash flow generation. This cycle, we're seeing the exact opposite, you would argue, is that it's the free cash flow generation that's actually the anomaly, not the disconnect in terms of valuation. So when you put that in a historical model, I'll say, it looks like a less risky proposition. I think the riskiest propositions historically, and we can talk about the 90s, or we can talk about it in other sectors as well, is when you see a clear disconnect between fundamentals and valuation. And right now, you're not actually seeing that in a lot of the stocks and in the technology sector as a whole.